Hey, future CPAs, what's up? Welcome back. Today, we're going to tackle a topic that trips up so many students during the board exams: share dividends versus share splits. I know, it sounds kind of tricky, but I promise you, by the end of this explainer, it's going to be crystal clear. Let's just dive right in and break it all down. All right, so here's our game plan for today. We're going to start with, what exactly are share dividends. Then we'll hit the super important 20% rule. After that, I've got a simple pizza analogy to help you get share splits. We'll put them head to head, and then I'll arm you with some killer brain hacks to make sure this stuff sticks for the LECPA. Okay, first things first. Just imagine a company wants to give its shareholders a little something extra. But instead of cutting a check for cash, it just gives them more shares. So you're probably wondering, what in the world is happening on the company's books? Yeah, this is the big question, right? How can you call it a dividend if no assets, like actual cash, are leaving the company? Well, the secret isn't about what's going out, it's all about what's getting moved around inside. The best way to think about this is like an internal reshuffle of money. No assets are actually walking out the door. The company is simply reclassifying a part of its equity. It's taking a piece of its accumulated profits, that's our retained earnings, and locking it in as permanent capital. This is a key term you gotta remember. It's called capitalizing earnings. Now here's where it gets really interesting. How we actually account for that transfer, well, it's not the same every time. Under Philippine financial reporting standards, it all comes down to one single magic number that you absolutely positively have to know. And this is it. 20%. This number is like a line in the sand for accountants. If a share dividend is less than 20%, you do the accounting one way. But if it's 20% or more, the journal entry is totally different. Seriously, burn this number into your brain. So here's the rule in a nutshell. For a small dividend, anything less than 20%, you have to use the fair value of the shares to decrease retained earnings. Why? Well, the thinking is that it's small enough to feel like a real substitute for a cash dividend, so we use its current market price. But for a large dividend, 20% or more, you only use the par value. That's because a massive distribution like this is seen less as a dividend and more like a total company restructure, kind of like a share split. And speaking of restructuring, let's flip over to the other side of the coin, the share split. I promise you, this one's way simpler, and I've got the perfect analogy that will make it stick in your head forever. Okay, for a second, just forget all the accounting jargon. I want you to just picture a pizza. Trust me on this one, this is going to make share splits impossible to forget. Okay, so imagine you've got a pizza with 4 really big slices. Each one of those slices is a share. Now, a 2-for-1 share split is basically like taking a pizza cutter and slicing each of those 4 pieces right down the middle. So now you've got 8 slices. So here's the question. Do you have more pizza? Nope. You have the exact same amount of pizza. You just have more smaller slices. And that, my friends, is a share split. The total value of your investment, the total shareholder's equity, is exactly the same. And right here is the biggest difference you need to remember. A share dividend always reduces your retained earnings. But a share split, it never even touches it. It doesn't affect any account balances at all. All you do is make a quick note in the books, a memorandum entry, that just says, hey, we have more shares now and the par value for each one is lower. That is literally it. All right, it is time for the main event. Let's put these two head to head in a little showdown so we can really hammer home all the differences. Think of this next slide as your ultimate cheat sheet. Okay, let's break this down. The only thing these two have in common, they both increase the number of shares out there. That's it. Now for the differences. Par value? No change in a dividend, but it always decreases in a split. Remember, our pizza slices got smaller. Retained earnings? A dividend always takes a bite out of it, but a split never touches it. And the big one, total equity. Absolutely no change for either of them. The size of the pizza stays exactly the same. Okay, cool. But what happens when the math gets a little messy? Let's say a 10% share dividend is declared and you own, 23 shares. You can't get 2.3 new shares, right? So let's quickly go over how companies handle these weird little fractional shares. It's actually a pretty clever fix. Instead of trying to issue a piece of a share, which is just messy, the company gives you something called a warrant that represents that fraction. You can then collect these warrants and combine them, or maybe just add a little bit of cash to round up to a full share. It keeps everything neat and tidy and gives the shareholders some options. Okay, let's bring it all home now. I'm going to give you 4 takeaways that are absolutely non-negotiable. These are your brain hacks to crush any question on this topic when you're sitting for the board exam. Brain hack number 1 is, you guessed it, the 20% rule. Just say this to yourself: small is fair, large is par. Small dividends use fair value, large dividends use par value. This is probably the most tested concept from this whole topic, so you have got to know it cold. Brain hack number 2, just remember that splits are simple. Seriously, if you see a problem where the par value per share changes but retained earnings is left completely alone, you know it's a split. It's just a cosmetic change, really. No value is actually created, it's just repackaged. And hack number 3 is what I call the journal entry test. When you're in the exam and you're starting to feel that pressure, just ask yourself one simple question. Does this transaction need a debit to retained earnings? If the answer is yes, it's a share dividend. If the answer is no, it's a split. It's a super fast, simple way to figure it out. And finally, a super high-value brain hack just for us here in the Philippines. Under our tax code, when you receive a share dividend, it's generally not considered taxable income. And why is that? Well, because you haven't actually received any cash or assets. Your total net worth hasn't changed. Knowing that little piece of info could definitely score you some extra points. So there you have it. You are now totally prepped for any question on share dividends and splits. But I'll leave you with one last thing to think about that goes beyond the journal entries. Which one of these moves, a small dividend, a big one, or a split, do you think sends the strongest signal to the market about how confident a company is in its own future? Give that some thought. Thanks for hanging out, and I will catch you in the next one.